don't listen to the policymakers, listen to the C-suite in corporate America. Why is that so important?
Because if you just look at your macro models, they're not capturing structural change. And there's a lot of structural change going on in the economy. So listen to those driving. I completely agree with Rick. Business investment is going up. You have strong household demand. You have strong corporate demand. You have strong government demand. Do you really want to put the Fed on top of that? He spoke about a really important thing, which is resource misallocation, because the price signaling mechanism is distorted. That's not a good thing. We have excessive, and I would say irresponsible risk-taking in some parts of the economy. That's not a good thing. We have a housing market that's pricing out Americans. That's not a good thing. So when I look at that, this is time for the Fed to start tapering. If it doesn't, we don't only risk the durable, inclusive, sustainable recovery, we also risk the Biden administration's agenda. That you already have people say, cut on fiscal. The economy is too hot. Actually, no, keep the fiscal, because that's investing in physical and hopefully human infrastructure.
That's your argument in the Washington Post this morning, Mohamed. Just published the title, "The Fed's ultra-loose monetary policy could hurt both the economy and Biden's agenda." Mohamed, Bill Dudley has made the point that when they do go, because they're waiting too long, they'll have to go much more quickly and rates will have to go higher. You've had a little bit of a difference with Mr. Dudley over that, the former New York Fed president. Is that gap sort of tightening for you and him, that maybe that's the scenario you could see playing out?
Look, I have tremendous respect for Bill. And when Bill says, look, they're going to slam on the brakes in a really big way, I pay attention to what Bill is saying. He was in the New York Fed. He understands how these dynamics are working. So, you know, I pay attention to what he's saying. The reason why I don't think we get there as fast as he said we may get there is because it's not just a question of what they should do. It's a question of what they're willing to do. And this Fed is very, very concerned about another disruption to the markets. They remember 2013. They remember the fourth quarter of 2018. So they're going to go slow, even though they should go a little bit faster than they have been so far.